Good morning and welcome to our 2021 Automotive Outlook. I think we can all agree on one thing: 2020 is something we would like to put in our rearview mirror. But once again, we learned just how resilient the automotive supply base is. And today, we're really excited with our lineup of speakers to really walk you through where we're going. What's in the front windshield, right? I mean, just a tremendous revolution happening in the automotive sector. And quite honestly, it's probably once in a lifetime. And it's very, very exciting. We see tremendous opportunities for the supply base. But yes, there will be winners and there will be losers. No doubt about it. First, I just wanted to let you know there is a questions toolbar to your right. If you just click on that little box there, if you have questions, we will try to get them at the end of each speaker's presentation or at the end of the overall program. So please feel to send in questions as need be. Now, first I want to introduce is Jeff Shuster. Jeff will be talking about kind of our big picture, where the outlook is, where the forecast is going. Obviously, it's very, very critical to understand, volumes relative to our suppliers. Next, we're going to go down another level, and we're going to really focus on electrification. Obviously, I think you can't open a paper or article or an internet to see something on electrification. And you might remember it's been 5 years since we had Paul first present at our Automotive Outlook here in Sterling Heights, and everybody was kind of scratching their head going, yeah, I don't see that happening. I don't think that's going to be that. I don't think that's going to. And now, Paul's in high demand, no doubt. What's happened the last 5 years is amazing, and we're just at the cusp of a revolution. And finally, we want to go down one more level is how do we take a look at strategy around electrification and how your business is going to be impacted. Our goal of our programs is really around thought leadership. We want to pull you out of your business for, yes, a couple hours. It's a little longer, so grab some lunch, stick with us. But we really want to not just talk about these trends, but we really want to have a plan to help you not only talk about, think about how we execute. How do we help you grow? And we've seen some tremendous opportunities with our clients already that are seeing new programs from new customers, and we want to help you be able to execute on those opportunities. Click here. So Automotive Reality, right? So electrification. No doubt, right now electrification makes up around 3%, less than 3% of all global sales, but is projected by 2030 to make up 25 to 30%. And Jeff and Paul will expand on this for sure. But what does this mean? It means a tremendous impact to the supply chain. As electric cars, make up electric cars have much smaller percentage of part content. So are you on the winning side or the losing side? We'll talk about that. Sharing, right? Not only data sharing, ride sharing, and maybe the ride sharing we can put off to a little box right now, due to the pandemic, that's been a little bit stalled, but think of the impact. Think of all the new vehicles that could be on the road, robo-taxis. So tremendous opportunity for suppliers. Connectivity. No doubt 5G is going to change how cars are connected and the amount of information that we receive in our cars. We're already seeing it in some higher end vehicles. It'll truly change the auto industry. And what does it mean, the impact? I want to have that. I want that in my car. And so it'll make you potentially move into a new vehicle sooner. And autonomy. This is me personally, level 1, level 2, and level 3 is probably, I'm comfortable with that myself. But level 4 and 5, we're still a little ways away. Doubt, federal, state, local, the rules of the road all have to be ironed out. But it is coming, and it's going to impact, no doubt, our future vehicles. So is it the end of the ice age as we know it, right? Not so fast, but no doubt we are, maybe in the beginning of the end, maybe 2050. And you'll see from our next slide where electrification is going. But right now, what is the real impact is that we need to act now. We need to think about what we're producing and where that is going to be in 5-10 years from now. Diversification, again, begins now. Looking at new markets, right? And we have worked with a company called Twist Think to help companies innovate and think differently about the products they make or the services they offer and how it fits in to the new world. And so maybe you've seen this slide, right? But it's getting closer and closer. 2030 suddenly doesn't feel that far away when you think in automotive years. It takes a long time to, launch a vehicle and prepare a vehicle. And now California has, really been focused on 2035. And with the new administration is going to move the ball down the court probably a little bit faster. So this revolution is upon us, and it's moving very, very quickly. And what can you say? There's over $200 billion being invested and probably growing from that number in the next 5 years in full EV. So it is a clear winner. And you can see that right in our own backyard here in Michigan, where the Hamtramck plant. Look at the opportunities for investment, right? Investment in $2.2 billion. Think of all the suppliers, machine builders, manufacturing solutions, system integrators. And now you begin to extrapolate this across North America as these OEMs begin to transform their plants into the next generation vehicles. But look at also how the value chain has really been disrupted, and for good. There's lots of design and engineering opportunities. We think of many clients that have done, working with, whether it's Rivian or Lordstown or, Tesla, and the list goes on. So the opportunities on the front side for prototype, design, engineering is in low volume production is tremendous. And you move down the scale, it's even impacting marketing and sales, as you see General Motors, going to their Cadillac dealers and saying, hey, are you in or out on we're going all electric. And so it's impacting the complete supply chain, and it's coming fast. And our point is that we need to prepare and plan now. So where does that really leave us from a, just a high level supplier prediction, right? Ultimately, there is a heightened focus on strategy. And we ask you to hang with us, and I think Dan Bruce is going to give you some of that roadmap, which is going to be very critical to sustainability. Ever more, and we've had many of our manufacturing outlooks focused on product innovation, right? You have to remember there's tons of opportunities, new components and architectures, but there's no doubt electric vehicles have a lot less parts and over 80% fewer moving parts. So think about where you fit into that value chain. We see tons of opportunity in certain sectors, and then we see certain sectors like obviously powertrain that is primed for consolidation. Are you thinking about and looking at new entrants? Whether it's Rivian, Lordstown, Lucid, and I know we've been a lot of companies are skittish about taking chances on some of these players, but some of them are very well funded if you do your homework. And we're focusing, suppliers to look at these opportunities, right? Because the traditional OEM may not be enough for you. You need to expand your customer base. And how do you do that? And that's really a focus of Dan and the strategy. And consolidation, yeah, we can see it. We see that continuing to happen. So especially among suppliers producing, that are going to be phased out, like Powertrain. It's, whenever you have an industry that is going to lack growth, it's primed for consolidation. So we see that continuing. And those that can continue to innovate in materials, we've seen that with several of our clients with carbon fiber and lightweighting. Very exciting. That is going to only accelerate in the future. And finally, capability expansion, right? Where are you focusing your energy and your dollars, right? It's very, very important that we, continue to invest in technology and software. And it's a change. I know for our smaller tier 1s and tier 2 suppliers, it's a real shift in thinking and execution, and that's where we are here to help you. But all this ultimately depends on your access to capital, a strong balance sheet, your ability to attract, retain talent, your ability to build scale, whether it's to buy scale through add-on acquisitions, or are you going to sell into scale? And ultimately, it's how well you can innovate. We've been focusing on that for years, and we consider that the number one sustainability. If there's anything you can invest in, is to, once again, even if you've been in business 10, 20, 30 years, think like a startup, act like a startup, innovate like a startup. So I want to thank you for joining us today, and we're going to welcome, I'm going to turn it over to Jeff to really give us a outlook into 2021. Jeff, you should now be the presenter.
Great. Thank you very much, Tom. We'll go ahead and hopefully show you my presentation. All right, are you guys seeing the presentation?
Yeah, yep.
Okay, yep. Perfect. All right, first test has been passed, and that is turning myself off mute and actually getting the presentation on the screen. So I think it's gonna go well now. Anyway, thank you to Tom and to UHY for having us again. Appreciate the opportunity to speak to you and talk a little bit about what we see, obviously coming off of a very challenging year, but one that ended a little bit better than we previously would have expected. So we'll talk a little bit about that. As we go through the outlook, just to spend just a couple of seconds here talking a little bit about LMC if you're not familiar. We've got our brand pillars behind me. So just kind of focusing on that a little bit. We're 100% dedicated to the automotive sector. So looking at sales, production, powertrain, mobility, autonomy, connectivity, all of those trends that are driving where the industry goes. In doing so, we pride ourselves on being extremely responsive, not only to our client base, but to the industry, to help make smart decisions, as well as something that we have to be, certainly in this time last year and going forward, now that we are in 2021 and face new challenges, to do so in a flexible environment. So with that, let's take a look at where we are with automotive. I think it's usually good to start off on a very high level. So kind of looking at one of the most important drivers, I think, when you look at the overall automotive space, and that's the economies or GDP growth. Obviously coming off of a challenging year, looks like the year is going to end for global GDP growth down about 4%. You can see the how that changes around the world. So the U.S. Bounced around between 4.5 and now looking to come in a little bit stronger than expected at 3.5 when it's all said and done. Europe is the one area that I certainly was hit a little bit stronger than the rest of the world, down almost 7.5%, and China outperforming the rest, down just 2%, but also coming off of north of 6% growth rate in 2019. Fast forward to this year. So what are we looking for from an economic standpoint this year? And that is certainly recovery. So we had a relatively deep recession, but short when we look at 2020. Obviously a lot to play out here on an economic standpoint and various elements of that when we look around the world, but nonetheless about a 5% growth. When we look at the globe, US, I think with the new administration coming in, the latest assessment is, and we're going to hear, I believe, tonight about additional spending and stimulus likely to lead to stronger economic activity, at least in the short run. We'll have to see how that affects the longer term or the medium term outlook for GDP, but looking a little bit stronger than previously expected at a little over 4% growth rate. Eurozone bouncing back as well. Some of the uncertainty, there's still obviously uncertainty with some of the trade and how those are executed with the Brexit deal, but at least there is no uncertainty with the Brexit deal anymore. China, a very strong recovery to about an 8% growth rate when we look at China. If we take that down to the vehicle market, looking at global vehicle sales, this is still an estimate for December. We don't have all the reporting in around the world. US certainly is in, Western Europe is in, China is in. So we have a pretty good indicator that we saw a nice little boost in the fourth quarter in terms of the selling rate. This is looking at vehicle selling rates here, so the vehicle SARs on a monthly basis, as well as then the translation of that into annual sales. You can see obviously coming from a very, very steep decline. If we look back in March, where the selling rate dipped below 50 million units, and if you compare that, let me get my arrow here, compare that to where we were back in the Great Recession, not only did we fall much steeper, but much deeper as well. The recovery has been extraordinary, frankly, again, on a global scale, with an industry, with a society that really has had to adapt to different norms and different ways to get business done, including selling vehicles and producing vehicles for that matter. So again, a pretty strong rebound and a nice prospect as we head into 2021 with the news of vaccines and other positives. Just taking a quick peek at the levels of recovery, we've really put them into 3 bands here. So when we looked at the recovery from, again, that March-April timeframe, depending on where the low point was, China obviously the first to see some impact in February, but you can see very quick rebounds. Some markets a little bit slower than others. India, the US was a little slower and tempered pace. Even though it was outperforming our expectations, you saw much stronger recoveries across Western Europe, across China. And actually, if you look at Korea as an outlier, Korea actually gained volume in 2020 as opposed to declining. So really the only market that we saw gains in last year. Much of that has to do with how quickly they contain the virus, but also the notion, at least in the larger cities, of using vehicle purchases as personal protection equipment. So we did see that drive some sales in parts of the world, including the US. I think the level of demand was a little bit stronger. The lagger really has been Brazil, although as things picked up and recovery took place in the second half of the year, that continued through December. So a little summary then of where the world ended. So we've got, again, numbers still coming in, but it looks like it's going to be down about 14% from 2019, just under 78 million units. You can see everything when you look at the summaries around the major markets, everything is in red. South America, the outlier there. Europe again down more than the rest of the world, similar to what we saw with GDP. lockdowns and the second wave really hitting a lot stronger in Europe in containing some of that recovery pace in the fourth quarter, even though the fourth quarter was a little bit stronger globally. US picked up some ground. Lagging was Canada and then Mexico. We'll take a look at the makeup of that a little bit later, but down about 15%. As you can see, China down only 4%. The rest of Asia, similar to North America, down 15%. So if we fast forward to this year, all those red arrows go green. So looking at a year that is expected to be up about 11%, so hovering in the mid 80s from a light vehicle volume standpoint. Again, there's a lot of uncertainty still. Obviously, some positive news, as I said, with the vaccine, but how the virus behaves with the vaccine, with the mutations, the rollout of the vaccinations in all the major markets is going to have an impact on light vehicle demand as well as the economies. So this is going to remain very fluid, I think, at least through the first half, but probably through most of 2021. Looking at the specifics, though, you see North America, Europe, both in very similar recovery, even though North America didn't fall as steep as Europe did. So looking at about 18.5 million units across those two markets. China picking up about 7% to back over 25 million units. You've got South America picking up quite a bit of volume there, but again, a risky environment there with that 800,000 unit growth. And rest of Asia, so you've got less support in Korea, which grew last year, so we see some leveling off there and some transitions over to growth in not only Japan, but pretty strong recovery in India, which took a significant hit last year as well. And I know Paul's going to get into the details, certainly of the electrification trends and battery electric vehicles in general, but I wanted to put some context, and I've got a couple of slides on our view of it, put some context into what happened last year. We don't have December numbers for BEV sales in most markets other than the US, but I did want to draw some attention to this in a market globally, and this is through November, where vehicle demand was down 16%. We had BEV demand up almost 20%. So that's a pretty stark difference between the standard market, which includes all vehicles, obviously, and the BEV market. So a tremendous amount of growth. Obviously, a lot of this is regulation driven. Europe, we saw very strong growth. China, continued growth. And you saw a less of a decline in the US, but a BEV market in the US that still declined about 10%, again, compared to the 15% down last year. Again, pulling in a little bit more context to what happened last year, when we look at Tesla as a component of the global battery electric vehicle sales, last year accounted for 23%, the same as in 2019 when you look at the whole year. Now, Tesla had been gaining some ground throughout 2020, but if we transition over to the right of the slide here, you'll see why they lost some ground. So you had battery electric vehicles really taking off in Europe, accounting for 32% of global BEV sales last year. China was 48%. But look at the transition of Tesla sales in Europe from 30% down to 20%. So some of that obviously has to do with the slow ramp ups of some vehicles or getting some vehicles to Europe. Obviously those, until the factory in Germany is completed, those are imported. So it's an allocation issue as well to some extent, because imports are much more pricey in Europe. However, that's a 10% hit to the share of Tesla. So if you kind of equate that, as the year progressed, Europe was taking off and Tesla was holding. So their volume did increase, but their share didn't grow on a global level in 2020 as it was expected to. You can see where it did grow though. China, the addition of the factory there, certainly helping ease some of the constraints on a supply standpoint, but also opening consumers to more localized feeling of Tesla sales and fending off some of those startups in China as well. US was down to under 40% of Tesla sales, so we'll talk a little bit about that later as well. So diving down into North America, so looking at North America demand, as I said, the US was the market that performed better than the other two, down just under 15% last year. So bringing the market overall to about 17 million units overall for the year. And as we equate that to the rest of the market, so Canada came in about 20% down. Again, that was looking much worse. So the market there in Canada did perform a little bit better as the year progressed. Mexico was hovering in this 25 to 30% range throughout much of the year. So it really held in that weaker performance, coming in at just under 28% down. As we look at next year again, or excuse me, this year, we're looking at getting back to that 18.5 million units, as I said on the demand slide overall for the world. US up about 9%, Canada about 11%, and you see Mexico also about 9%. Volume-wise, obviously the US is going to account for the majority of that increase. So I wanted to spend a little bit of time on the US and what happened last year, a little reflective as we set up 2021. And I wanted to really illustrate just how much the market did outperform expectations. This is our forecast green line for the selling rates for the year. So kind of looking at 2019, obviously you got a little bit of noise in there, but really hovering around that 17 million unit selling rate. We were expecting that to hold, but then some risk coming in the second half of the year and dipping a couple 100,000 units down to 16.8. Obviously, COVID hit and we saw projections drop significantly. So this is initially the hit that we were expecting after seeing the March and April numbers. This is a May forecast a March forecast that we're looking at. And obviously, when we looked at that and looked at the progression forward, we were really expecting a much deeper decline in April and into May and even into June before some recovery. When we look at what really happened, and I'm going to toggle between these a little bit. So you had a little bit of underperformance later in the year and some leveling off in the fall. I think you could equate that to the start of the second wave and an increase in infections and in lockdowns and restrictions that we saw in the late September and into the fourth quarter. But that performance really coming out of a decline in April that was muted significantly from where we were expecting it to be, and then recovering pretty substantially, again shows I think the resilience and the strength of the industry as well as consumers. Here's what it looks like from a monthly pattern. I wanted to bring in a few other, I don't need incentives. I actually have the incentives on here. So I wanted to bring in a few other pieces of information. So this is the overall monthly pattern. There's some differences here going on with selling days. As an example, November was down 16%, but there were 3 less selling days. December was up 6, but there were 3 extra selling days. So you had some noise going on in the numbers. But generally, the market did improve. Incentives, while they were muted to some extent from where they likely would have been if there was more inventory, they still were about $4,200 on average compared to $41 a year ago, so still slightly higher. Otherwise, we would have expected them a little bit stronger, especially given the increases in transaction pricing. So you've got a big bump. Every month throughout the year has been a new all-time high in transaction prices. We're sitting at right around $38,000 on average. That's a 9% increase from a year ago. And keep in mind, these transaction prices that I'm showing you here are already net of that $4,200 incentive average. So this is a pure pricing increase to consumers. A lot of things driving that. It's not as much mix as you would expect. Obviously, consumers are buying more trucks, so you would expect that to affect the mix, more SUVs and pickups, and affect the transaction price, and it is, but not as much as just the fact that pricing is holding, partly because of less overall incentive use as a percentage of price, but also consumers wanting vehicles that are in short supply, and those that are in supply tend to be the higher trim levels. So trim is definitely affecting, and options are affecting transaction price. We'll get into the chip shortage issue that the industry certainly didn't need this year, but that's going to keep things in this pattern. We believe at least through the first quarter into the second quarter. A little bit on why why we're seeing those high transaction prices, why we're seeing short inventory of pickups and SUVs, and that's because those are in demand. So in a market that's down 15%. I had pickups that were down just 6%. You had SUVs down 10%, and some vans. So this would include your commercial vans and delivery. Obviously, we're all getting a lot of home deliveries from the various sources, whether it's FedEx, Amazon, UPS, or that unmarked rental vehicle that someone's using to make a delivery for Amazon. So all of those purchases are affecting van sales as well, which kind of held where the industry was. When you look at minivans and look at the cars, obviously taking a big hit in 2020, both down nearly 30%. So we're now a little less reflective, and let's look at what's going on with this year when we look at the U.S. pattern. So again, this is looking at the selling pattern. So similar to what I showed you in the previous slides, our forecast for 2021, I've put in here with the 2020 actual pattern. So you can see again that big dip. We're looking for a little more stability this year, similar to what we saw in 2019, but on a scale that's about 2 million units lower still. So 1.5 million to 2 million units lower, I should say, as we're expecting that pickup to occur a little bit stronger in the second half of the year. So our official forecast is coming in about a 9% increase, going from that 14.5 to a little over 15.5 million units. But as I suggested, we do have certainly some headwinds as we look at inventory constraints, as we look at a chip shortage. I'm going to talk a little bit about the impact of that, as we look at a new administration, and just the response then to the virus itself and vaccinations. Obviously, all of this, getting the service industry back up and running, all of this is going to affect vehicle sales as we look at the 2021 pattern. So expect likely a bumpy ride, at least in the first half of this year, and some potential risk ahead. So jumping over to production a little bit, again, to set up 2021, just wanted to look and show the recovery that we did see in 2020. So the last 4 months of the year were positive, and that's the rebuilding of this lost inventory that we see here when we look at 2020 April and May, a significant pullback. This pullback here in March is mostly China, and then we saw the rest of the world, North America, Western Europe, zero production and sales in India in April, and then obviously that recovery. So manufacturing got back up and running, very challenging and complex supply chain, but and there were hiccups, but generally speaking, the disruptions were minimized, and obviously you can see a pretty strong growth rate with positive territory in the second half of the year. Looking at the volumes, again, we're not completely summarized here for December, but we're expecting it to come in about a slightly stronger decline than demand, about a 16% decline, again, with that robust pickup in that last 4 months of the year. As we look at 2021, we're looking at a market, so comparing, just make sure it's clear, I'm comparing the current forecast for 2021 with our pre-COVID forecast. So we're looking at a market that's down about 5% from where we were expecting it to be before COVID hit. But nonetheless, we're looking at about an improvement of nearly 20% from the 2020 levels. The first quarter pattern that we're expecting is going to be impacted by the semiconductor shortage. So we'll take a look at that in a couple of slides here. To kind of set that up, I wanted to just illustrate where inventories are around the world. US is very unique, extremely lean when we look at inventory levels. In fact, if you look at, so you had demand You had the pullback in supply, which pulled inventory. This is blue line here representing raw inventory levels. So that's under 3 million units. The bars are then representing days supply for the current year versus a year ago. So you had days supply kind of hovering in the low 60s to 50. You had inventory that got pulled back because of the plant shutdowns. And then as demand came back, remember those demand slides where you saw that pretty strong recovery in demand. We didn't see that with production or inventory levels. So production was basically back on to meet demand. It wasn't building inventory until we got into the beginning of the fourth quarter. We started to see, and it looked like it was going to be a trend upward to build some inventory. And with that strong demand through the end of the fourth quarter, that depleted some of that inventory buildup. So we're kind of back where we started in May at a similar inventory level and down substantially from where things typically are at this time of year. Day supply falling below 50. Don't remember it ever being at that level. So extremely low day supply, and something that is certainly not setting up the year the way we wanted it. And then obviously the chip shortage is holding ground too. Looking at other markets, in China in particular, this is a market that was ahead of COVID was destocking. So we saw this is looking at the difference between production and retail sales as an inventory proxy. We did see a drawdown in late 19 and into the beginning of the year again before COVID hit, where inventory was getting reduced. And then since the plants restarted, and plants in China were down only an average of 3 or 4 weeks, so much less than the rest of the world. That inventory has been rebuilding, and you see throughout the year has been rebuilding relatively strongly. So I think when you look at that and then look at Europe, which was really in a similar position to the US with the pullback in supply, but because demand did not recover as strongly in Europe, we did see raw inventory levels build as well as day supply build to nearly 70 on average. So what does that mean then for our latest crisis that the industry has to weather, and that is the semiconductor chip shortage, the chip shortage in general. So we put a couple of scenarios together. It's very early, obviously, and things are very fluid. We're still getting indications on some shutdowns, waiting for others to announce their impacts, or at least give us some indication of their impacts internally. But we are definitely looking at a market in the first quarter, if not the second quarter, that is going to face a pullback in overall supply levels. And North America is expected to be hit somewhere between 5 and 10%. Right now, we think about 5% in the first quarter. January has not been as impacted yet for most, with the exception of FCA and a couple of plants for Ford and Honda and Toyota, but that's likely coming as we get into February and into March. And that does put some pressure on demand, although we haven't changed our demand forecast, at least at this point in time. There is some risk, I think, to that. China overall expected to be down 10% in January, but some improvement. We see and are hearing of some suppliers bringing in chip supply from their European operations to offset some of the pullback. But also, if you remember that last slide where China had been building inventory, this is an opportunity, at least with some OEMs in China, to reduce some of that inventory. Most exposed, at least at this point, probably is Volkswagen. Volkswagen is sitting on at least with some vehicles, a unique chip that is only unique to Volkswagen and cannot be replaced with other chips, much like a lot of the chips that are being used are more generic. So that chip in particular is in short supply, and I think there's some risk associated with that. It looks like Korea is going to avoid a major headache here. There saw some stockpiling, likely in particular with the Hyundai Group. GM in Korea is at risk, I think, with their global supply chain. But you also have two of the largest chip manufacturers in the world in Korea, and likely good relationships, certainly with the manufacturers there. Europe also sitting on a pretty strong setback. We're looking at very similar numbers, maybe not quite as strong of an impact in the first quarter as North America. So in that 4 to 5% decline range, but again, they have a little bit more inventory buffer than North America does. So overall, market-wise, you're looking at anywhere between 1 million and almost 2 million units of impact in the first quarter, about 0.5 to 1 million in the second quarter, and we think some of that will get made up by year end. So we're in right around 1.3 to 2.5% decline from our base case forecast. So this is then what it looks like if you bring in that assumption of a decline of 1.3 million units for the year. You still have growth. You have about a 16% increase in 2021 from 2020, and you have then a market that's at a little over 86 million units. You've got growth in South America. Again, that's probably at risk to some extent. Only 6% growth in China. That's because of that inventory build that we saw. North America, Europe, both, and the rest of Asia up both in that 20% range, getting us to that 86 million units. So I want to talk a little bit about launch activity then, shifting gears a little bit and how that's driving and may have changed. We've got a kind of an outlier on this slide, and that's the first quarter of this year, and that likely could still spill a little bit. We saw, again, when the pandemic hit, lots of vehicles were impacted, some of those that were in production already, but those that were going to be launched at some point in the year and then even into 2021. A lot of those from second quarter through fourth quarter as the year progressed got pushed out a month, a year, or a few months. So this is what the summation of that is a lot of vehicle launches being pushed globally into 2021, in particular the first quarter. So you have a significant increase of first quarter launches. That's unprecedented, the number of global launches. So that's several launches, in some OEMs, and this is not picking up some of the multiple launches that are going on in multiple regions. So again, highly complex to launch a vehicle and get the supply chain organized, and to do so in a virtual environment. So I think a lot of those launches, in particular those that haven't started yet in the first quarter, are still at risk to slip likely or possibly into the second quarter. I think that, again, the semiconductor shortage puts additional pressure on launches if we can't have production factories up and running. So you've got vehicles that have been launching or ramping up, in the case of the Model Y, since the first quarter of 2020, and they're still ramping up. So that's not an unusual situation across the industry. You've got also some very key launches from a manufacturer standpoint with Ford, with the Mach-E, the F-150. You've got the Rogue Sport or the Qashqai globally for Nissan, and later this year, the CR-V as well. So let's look at that path forward. This is taking a look at the forecast, again, bringing in our previous forecast, the black line there in December of 19. So the pre-COVID forecast, the May decline, when we thought everything was going to be down substantially, and the risk was certainly weighted towards the downside, bringing a market. Last year, we were expecting it as low as 70 million units. As you can see, it ended up more like 78 million. But I think then as you go forward, our current forecast in January has the market at that almost 87 million units, up to almost 92. So getting back toward and back to pre-COVID levels by 2022 at a global level. But it's important to note that the market still did lose a substantial amount of volume. Cumulatively, that's 22 million units from 2020 through 2022. So over that 3-year period, 22 million units evaporated from the industry. So that's pretty substantial, certainly in something that is affecting margins, affecting revenue, as well as the vehicle development and investment into, not likely investment into electrification, but certainly investment into autonomous vehicles, mobility, things that are much further out that aren't drawing a near-term return. When we look at the forecast going forward, we're pretty well locked in at 2020. At 2021 and 2022, you've got a little bit of downward bias on that bottom right quadrant there with the scenarios, the ranges. So that's really anywhere between kind of where we were, a flat market, and about 90 million units is the range that we're putting at it this year. And next year, pushing up to 95 million and down to around 85 million. So kind of fairly balanced in 2022. A little bit of downward bias just with the uncertainty around where the virus takes us this year. The recovery path then is going to be different around the world as well. So looking at a market that's expected to be growing at a compounded annual growth rate, or CAGR, of 7% from 2020 to 2023. You can see some outperformance. No surprise, I think most of those markets are emerging. So India, Brazil, rest of the world, that's Middle East, Africa, some of the smaller markets there picking up strong growth rates, but also a fair amount of risk. Eastern and Western Europe also growing stronger than the rest of the global market, but that's because there was a stronger decline in 2020 as well. So those that outperformed, with the exception of the US here, China, Japan, South Korea growing at a smaller pace. South Korea is almost flat, but again, hitting very strong levels in 2020, so a strong base there. A little bit further out in the recovery path for the US in particular, so we're looking at, as I said, about 15.7 for the year. That gets us back to not till near that 17 million unit level that we saw in 2019 until 2024, at least at this point. Obviously, there's a lot of things going on. The stimulus in the near term is something that you're going to want to keep an eye on, because how that's handled, how much goes out, where it goes out, all of that certainly is going to impact this year. And I think there could be potentially some upside here if that, in combination with vaccinations, roll out better and quicker than expected. As we look then at the longer term, looking at the regulatory environment is going to change. Obviously, that's going to affect EVs under the new administration, but so is trade policy. We would expect some of the uncertainty in the tariff use and the tensions with our trading partners to ease over under the new administration, and I think that's generally going to be a positive for the auto industry. On a segmentation standpoint, you're looking at a market that again is diverse when you look at the various segments. So this is through 2024, the growth rates. SUVs continue to gain ground at a 6% clip, pickup trucks at a 5% clip, and again, keeping in mind that's roughly ahead of where the industry is in the same period. You've got car segments, that's where it's coming out of. So the car segment's declining. You've got losing share and volume. You have the van segments, minivan segments losing share but gaining a little bit of volume. Premiums, the sporty environment, or sporty cars, I should say, get a boost mainly because of some new entries in there, as well as premium EVs coming out of Europe, as well as North America. And then the total premium market overall, additional ground into the SUV segments and the EVs, as well as EV SUVs driving that growth. Looking at global production, so as I said, we are taking our base case forecast, which will be coming out later this month, down likely to that new short-term risk level, taking that 1.3 million units out. That gets us to that 86.3. We think there's, when you factor in this could linger further or be more severe in the first quarter, linger into the second quarter and potentially beyond, there's another million units at risk there. So again, it's very fluid here, but I think I wouldn't call it a worst case, but more of a worst case, but not worst case scenario. You could look at a global market that's down as much as 5 million units this year because of that chip shortage, or other variables that are certainly driving some of the volumes. Utilization levels, lowest ever that we've recorded in the 40 plus years that we've been tracking the industry overall from a historical standpoint. So hitting a utilization down at 52% in 2020. We do see that improving, and as the year progressed, as we look at expectations through this recovery pattern, we've seen improvements in utilization. There are likely to be additional moves in various markets, Europe in particular, if they can get through some of the regulatory issues around potentially closing factories. But you've got the consolidation of PSA and FCA that likely is going to be driving that. Nonetheless, you had Ford announce earlier this week the closure of plants in Brazil. That is improving what's going on when you look at South America overall. But some of the other markets still, again, very low levels. China in 2023 still at 23%. You have North America getting back into the 70% range. Europe and Asia, less China, all back in the 70% range as well. So when you look at the overall, I wanted to just spend a couple of minutes before we wrap it up here on the overall global BEV market, kind of our view on things, and we see some pretty significant growth. Again, the overall hit from our previous COVID forecast, again, we did have growth or expecting growth in 2020 from 2019. But we're expecting things to be a little bit stronger than they came in. So it's down 8% from where we're expecting it, but we see pretty significant increases over the next few years, 10% this year, another 66% in 2022, and another 50% nearly in 2023. So growth up to over 6 million units by 2023. Again, pretty big increases coming off of a 25% increase in 2020. The drivers, as I said earlier, on the 2020 are going to continue to be the expansion in the race between China and Europe. We think Europe is going to outpace that growth in China and driving the overall volume in the short term. The US is starting to come on and lagging, but likely will pick up some volume here as well. Obviously, there's, I think, renewed interest in what's happening, and we've seen some improvements in a lot of the factors that have been holding us back from increasing a forecast, and that is battery life, infrastructure investment. We may hear about that tonight. We'll see. That's something that needs to happen, and obviously price. Price can be impacted by tax credits as well, something that we are expecting under the new Biden administration, a renewal of that. So throwing a lot of scenarios together, at least for the US, could take us into a range of up to, say, between 40 and 80,000 units on average over this period, an increase every year. But our base case, when you look out to 2030 right now, we've got over 15% share for BEVs in general over this period, in the US at about 9%. Again, I think a Biden administration probably puts the foundation in there to renew interest, which is strong with consumers. You've got supply there. If you can get some of those factors down, that could spill into the long term as well and bring a stronger growth rate in the US. Very significant increase in the number of models. We'll spend a lot of time on here, but up to over 500 BEV models. Every time we do generate a new forecast, these numbers are going up and continue to go up, so a strong increase. That initial 21 through 23 period, that boost there is really, again, a lot of the smaller makes coming on with small volume here in North America, but big volume increases and significant numbers of volumes in both China and Europe. And as it didn't affect really 2020 for the global environment, COVID does not affect, at least in a negative way. It may affect things in a positive way for the long-term forecast. So just looking at, for BEV, we've increased our forecast about 5 million units since COVID hit. And we've held our full, all the way through, from mild all the way through full battery electric vehicles, including battery generated fuel cell vehicles as well, through 2031, holding around 350 million units through that period. Again, this is 2020 through 2031. It's the cumulative totals here, not annual numbers there. So that is looking at a market that's almost a 20% share globally for BEVs, and almost a 50% share for some level of hybrid vehicle over this period of time. And again, I think we'll see how this plays out, but I think the virus itself and COVID, the impact of the pandemic, likely influenced a lot of people, not only from an investment standpoint, from a rollout standpoint, but I think an interest into vehicles and into clean vehicles likely increase the demand for these vehicles going forward. Just a little bit about where we see the landscape. The point here really is that Tesla's dominance, which has been remarkable, is likely to fall. To what level and to when, that's difficult to say. We do see Tesla doubling their volume from 2020 to 2025. So we're certainly not down on Tesla from a standpoint of growth, but there's a lot of new players coming in. And a lot on the line in a lot of these markets. Volkswagen in particular needs this to work for them to sell vehicles in many markets, including most of Europe. You have pretty significant growth in the small startups and boutiques. Some of that's already happened. Some of that's transitioning from startup in China to more mainstream. So there's some shifting going on there. Obviously, GM's commitment, Ford's increasing activity, Toyota, the rest of the European brands all jumping in the game here, likely to take some share from Tesla. And just to wrap things up, we'll just kind of pull these on the screen because I want to talk about them collectively. Getting back to kind of where we see the current environment, I think the growth and the recovery pace that we saw throughout 2020, in particular the second half, it's going to be hard to keep that level of activity around the world. We do think there's still a level of pent-up demand. We don't think it all was essentially serviced in 2020 through the period, but there are some roadblocks, and that's certainly getting the service industry around the world back up and employed, getting through this inventory correction, dealing with what's thrown at the industry, such as the chip shortage, also looking at incentives from governments in various markets, stimulus, again, something we'll hear more about tonight. All of those are going to affect the pace of this recovery and how the recovery takes place, and ultimately, if there is, or what the payback or the lower growth rates look like in the longer term. And obviously, the virus itself has not been dealt with completely or at all. We're still seeing cases that are posing issues, I think, at least through the winter months here. So with that, I'm happy to take any questions.
Yeah, thank you. We're Paul, if you want to begin, if you want to, Jeff, transition to Paul while he's doing that. We do have one question. It says, why do you believe that demand is at risk? Will people keep their cars longer, or is there another reason for demand being at risk?
1 second. Let me just see if I can multitask here by moving it over to Paul.
Yep.
Bear with me.
Change presenter button.
Yep, that's what I'm looking for. I seem to have lost it.
Right in the upper right corner.
Huh. Yeah, I think I went with a minimized version of this while I was presenting, so apologies. Give me a second. There we go. There we go. All right, all you, Paul. Okay, so why, I'm sorry, could you repeat the question, Tom?
Why do you believe that demand is at risk? Will people keep their cars longer, or is there another reason for demand being at risk?
Yeah, I think there's a lot of issues. The short-term demand being at risk has a lot to do with just the current environment. So the economy, employment, shortages of inventory, all of those uncertainty, I think, is affecting the short term. So that's affecting the recovery period. I think as you get into the longer term, and this is well beyond the period that I talked about, then you get into the impact of sharing and things like that. So I think that will have put some pressure on ownership. I don't think necessarily we're expecting to see people hold their vehicles longer. You know, you've got, especially in the US, you've had an increasing level of leasing. However, you do have longer loans. So those have kind of balanced each other and kind of held it where neither one of them are really having a strong impact on at least demand over the next couple of years.
And no doubt the short-term demand is still, even I spoke with some of the OEMs, and although their supply base has been resilient, it's still been tough to get totally back up to where they need to be.
Yeah,
So,
yeah, I think you make a very good point. It's below the surface and below, I think, what the media is talking about, but there's a lot of issues going on still with just getting people to come back to work.
Yeah. We'll see under the new administration how that gets impacted. Also,
Yeah,
agree. Jeff, thank you so much. Great presentation as always. Thankful for our partnership with LMC. Paul, I'm going to turn it over to you. We lost you had it up there.
All right, let's do that again.
There you go. You're ready to roll, and we'll turn it over to Paul to give us a real kind of a deep dive into, I know Jeff, I think see some real growth in electrification. I think it's going to accelerate a little bit faster and quicker, but love to get your viewpoint on it. So thanks, Paul.
Yeah, so again, Tom, thanks for inviting me to be here today. This is analysis that we've really been developing, as Tom had mentioned, over the past 5 years. Specifically, what I'm going to talk about is sort of the global impact of electrification. What do we see happening? How do we see the OEM strategies changing, which is a little bit about what Jeff talked about. But let me start with this, and as Jeff did, let me just give you a little update or a little background. So specifically for me, I'm a 25-year veteran of the automotive industry, mainly with tier 1 automotive suppliers. Most notably, I spent 8 years as the VP of Corporate Development and Strategy for Magna Powertrain and Magna Electronics. I was responsible for integrating Magna Electronics into the Magna Powertrain business, where really, about 10, 12, 15 years ago, started to see the real impact of electrification along with these other major trends that you see. And for this audience today, no trend is going to be more significant than electrification. I left Magna about 5 years ago to start a boutique strategy consulting firm. We have a team of strategists that work with mainly suppliers to help them understand how do these trends impact their business and how do they address them. And like I said, for this audience, I don't think there's any trend that's more significant than electrification. And what I'm going to try to do here over the course of the next 30 minutes is help you understand why 5 years ago we saw this happening. And as Tom mentioned, people were skeptical. And what that comes down to is really starting to get out of this inside mindset to an outside mindset. And let me explain that for a minute. When I joined the industry as a supplier, the whole industry was going through a revolution, which was lean. It was Kaizen. It was these type of activities that really became the focus of our industry. As a stable industry, really strategy came down to how do I optimize my costs to ultimately improve my profitability. Well, if we look at organizations over the past 30 years, and the executives that are now running these organizations, they come with this lean mindset in this view of what I can control in my own four walls. But ultimately, when we think of disruption, disruption is not an inside out thinking, it's outside coming in. And I like to tell CEOs all the time, this is a problem that your sales team can't solve, because it's not selling your current product harder, it's migrating to selling new products. products and new capabilities. And specifically, the reason I put this slide up there is to really illustrate this thinking, is operational thinking, a view of the next 12 to 18 months, and the typical business planning that we put into financial plans to raise capital is not the type of thinking that is going to help you see this disruption. And what I'm going to attempt to do today is walk you through much more of visionary thinking or strategic planning with a view of what's going to happen in the next 8 to 10 years to help you understand how you need to prepare for the disruption associated with electrification. So with this, let's first of all, just give you an overview. When we talk about electrification, we're really talking about this complete spectrum, as far as from the micro hybrids, which are simply start-stop systems, to mild hybrids, to full hybrids, to plug-in hybrids, and ultimately battery electric vehicles. Now, when we're talking about this as disruption, really the first 4 items that you see here on this chart really are all vehicles that still require an internal combustion engine. However, when you get to the battery electric vehicle, this is when we see the significant disruption associated with our industry. And this will have a profound impact on the countless suppliers here in the Great Lakes region. And again, I'll go into a little more detail as far as why that's the case. But specifically, here's just an illustration of what that looks like. What we have on the left is a $400 billion ecosystem. It is the internal combustion engine ecosystem, which is continuing to shrink. And as many OEMs, we'll talk about as we go through this, have actually stopped the development of the internal combustion engine in the associated systems. And this is why many suppliers here are starting to recognize, hey, I'm not getting the opportunities to quote the transmission parts that I once did. Well, that's because nobody is really creating these type of transmissions. They're creating parallel hybrid transmissions and power split transmissions in developing electric drive motors. So what you see on this page is the impact of the electrification when we move to battery electric vehicles. And we want you to understand how significant of an impact that is. And specifically, those on the left-hand side are mechanically driven parts, where we have roughly 125 movable parts in an internal combustion engine today. When we go to these electric parts, which are driven by semiconductors and electronics, what we have is less than 25 moving parts in a vehicle, just to help you illustrate the significance. So what I'm going to do is I'm going to talk about the forecast. First of all, in my presentation, then I'm going to talk about the impact and ultimately the strategies. However, today, for today's update, we're going to spend more time talking about the forecast, what the OEMs are doing and what we can expect, which, to be honest, is going to be different than what Jeff showed you. And the reason it's going to be different than what Jeff showed you is because we have a very different forecast method, where Jeff's forecast methods are really driven from the market. Ours is driven from a compliance base, more top down, as far as what is it going to take to comply with the legislation. And that is a very different method that will give you a very different view of what we can expect as far as this electrification trend and this disruption. And specifically, I like to start with this to say that really we believe that the global production or global propulsion roadmap is really understated. And it's understated for these 3 reasons. First of all, we're seeing an acceleration of the trend to legislate and ban gas and diesel vehicles. We're going to talk about that, and I'm going to share some of the latest data with you on that. Then specifically, the cost differential is basically disappeared. We'll talk about that. And then finally, we'll talk about the new OEM strategies, and we'll get into what are the OEMs doing and what's really driving their changes in behavior. So this is a chart I love to start out with. to help you understand, well, where is the legislation? Because this is going to be the driver of electrification over the course of the next decade. And specifically, what we've done with this chart is, first of all, at the bottom, you see the legislation that is in place in each of these major economies. So for instance, here we have 3 legislative factors. We have CAFE, which you know as miles per gallon. We have greenhouse gas emissions, which is basically mandated through the EPA. And they do have the power to shut down any OEM that doesn't comply. And then we have the California Air Review Board, which has a ZEV credits program, which we'll talk about a little bit also. But we have 3 legislative bodies here in North America. Probably the most strongest legislative body globally is what you see under Europe. And specifically what they do is they look at CO2 emissions from a standpoint of grams per kilometer, and they have the most stringent legislation around the globe at this point in time. And specifically, if I put this in the context, and I have put all of this in a context of grams per kilometer, so that you can see side by side what kind of legislation that each of these countries have. And specifically, if you look at Europe, Europe has the most stringent legislation today. And let me just walk you through that. The 95 grams per kilometer is basically the equivalent of about 54 miles per gallon here in the United States. 81 is the equivalent of 67 miles per gallon, and 59 grams, which was recently approved for their 2030 target, is the equivalent of about 92 miles per gallon. So when you step back and you think about this from a legislative standpoint, if you're going to legislate that the corporate average across Europe has to be the equivalent of 92 miles per gallon, there are very few options of vehicles that are going to meet that other than pure battery electric vehicles, a large mix of them, and plug-in hybrids. Those are the only vehicles that will really come close to that type of compliance. So what we've had here, and I add this in here because the Trump administration had proposed to freeze the legislation at the 2020 level, and we think there's going to be a significant change as a result of the Biden administration going forward, and I have a special excerpt to walk you through that at the end of this section. I'm not going to go through this in detail. If you want more of this detail, please send me an email and I'll share this with you, but this just gives you an idea of the number of legislation that's in place and when it takes place as far as these type of zero emission vehicle mandates. So specifically, what we've seen over the course of the past year is, for instance, basically in the UK, they're looking at 100% zero emission vehicle mandate. That means a combination of battery electric vehicles and plug-in electric vehicles to be mandated 100% in North America, or excuse me, in the UK. And we can expect the Biden administration to start to push closer and closer and closer to that type of mandate also. But I'll get into that further. So specifically, the second argument that we made is the cost differential is really disappearing. And specifically what we do, if we look at this chart, and if we think of that back in 2012, the legislation in Europe was 130 grams per kilometer. If you look at the drop to 95 grams, which is here on the chart, you'll see really the cost of the vehicle didn't increase more than $200. However, as we go out in this spectrum and we see the move to 81 grams, you'll see the cost impact to the vehicle goes up to about $600. But really, when you go to 59 grams, the reason it goes off the chart is because really there is not mechanical technology that can be applied that will meet that legislation. So that's why we have here, as we move from 54 miles per gallon to 67 to 92, ultimately what we have is the mandating of a higher take rate associated with these electrified vehicles. The other thing that's really happened here that I think is the most staggering is the cost associated with the battery and how quickly it's dropped. And this is a chart we developed just 3 years ago. And really, it's far outdated, but I use this as an illustration. And basically what we had at the time, 3 years ago, there was this huge research study that was done by ICCT. And what they forecasted was that the cost of a battery in 2015 per kilowatt hour was close to $1,000 per kilowatt hour. And ultimately, if you look at that over the course of the 15 years and the end of this decade, that cost was finally going to drop to below $100 per kilowatt hour. And based on that forecast that was developed just 3 years ago, what you could see was the impact of a battery electric vehicle with a 300 mile range. Basically was an $18,000 penalty, and that same 300 mile range for a premium vehicle, basically you'd get cost parity at the end of the decade. Now, when you calculate the fuel savings, you can see whether that was in Europe or that was in North America or China, that was accelerating that parity. However, what's happened really since the beginning of 2020, the cost of the battery has broken the $100 barrier. First of all, it was an announcement from GM that their Ultium battery system was going to cost less than $100. Then CATL, who is the largest independent producer of lithium-ion batteries for the automotive industry, came out with an announcement that they could meet $85 at the battery pack level and less than $65 at the battery cell level. And then what you had back in September is basically Tesla coming out and saying, well, we've broken the $65 barrier and we're below $60 when it comes to a kilowatt hour for a battery electric vehicle. And again, if there's any of this research, we've got several pages of research as far as the Tesla battery breakthrough we can share with you. So again, please feel free to send me an email if there's any of this information you want to go through in further detail. But this helps you understand how Tesla got there with factory simplification, vehicle integration, new material technology, new cell design. All of this is changing at a breakneck pace that just 3 years ago, people wouldn't have thought it could be achieved by the end of the decade. Here it is, the beginning of the decade, and we've already shattered those levels. This is, again, going to be another big driver when it comes to electric vehicles. I'm going to skip over this page for just the essence of time, but you probably all get this. Who are some of the most valuable OEMs in the world? Well, obviously, it's these battery electric vehicles. And just an interesting point, when we put this together at the end of November, NIO has gone from 63 billion in market cap to 88 billion in market cap. So NIO, a Chinese startup, is now the fourth highest market cap OEM in the globe. I'm going to skip over this, which is just talking about the electrification strategies, which again you can read at a later date. But this is something that's really staggering. Jeff talked about it. The huge bet that VW's made in electrification, basically to supply vehicles in Europe. They have to meet these targets, especially when you start looking at what's expected. And what they have, along with all these top OEMs, they've committed over $300 billion to electrify their vehicle fleets. And specifically, you can see the huge investment that's been committed by VW specifically. And if you remember back in December, the CEO of VW went to the board of directors and said, hey, I want a vote of confidence that this $91 billion is the right investment, that we have the right strategy going forward. And of course, what did he get? He got the vote of confidence from his board of directors. So organizations like VW are going all in. This is a very similar chart to what Jeff had showed earlier. However, this is just the top OEMs. And when you look at the top OEMs and the forecast for pure battery electric vehicles, again, when you look at just the top OEMs, you see 250 vehicles. When you add in the complete list that Jeff has with all the Chinese startups and all the smaller OEMs, you see that reaching close to 500 different vehicles by 2025. And of course, Jeff's got numbers that it will increase exponentially between 2025 and 2030. So this is another thing that I think for the suppliers here that are participating, this is something that you have to really appreciate and really have to start to understand, is that in 2019, there was 65,000 layoffs announced by the OEMs. And specifically, what was the number one reason they gave in those announcements? It was as a result of electrification and the fact that we're no longer developing engines and transmissions and the whole internal combustion engine ecosystem. They no longer have the need for the manufacturing and engineering ranks in their organization, and of course have started to eliminate those individuals from the organization. And we've seen sizable layoffs. Our expectation going into 2020 was that was going to start to ripple through the supply base. What happened before that started to take place was COVID. However, I do expect here over the next couple of years, we're going to start to see this ripple in the supply base as a result of layoffs, because the engineering efforts that are going into new engines and transmissions have stopped. This, for our Great Lakes region, is going to have a huge impact on employment. And this is one of the reasons why our mantra is, as suppliers, you need to be scenario planning. You need to be starting to think about what's next. And what next is not more forging parts. What's next is parts that are going to go in the new ecosystem associated with these EV vehicles. So here we share our forecast with you. And again, this is a very different forecast technique. We have about 80, 90 pages of analysis behind this. We can talk to you about each region around the globe, how it's going to happen. But what we're doing is we're looking at what is the efficiency from a standpoint of CO2 that you can expect with the vehicles as they exist today. Then what we do is look at the gap associated with compliance with the legislation. And what we do is we start to fill that gap with a higher amount of EVs and plug-in electric vehicles. And why? Because the legislation is moving towards credits associated with zero emission vehicles, which is the combination of plug-in hybrids and EVs. So we build this global forecast, and what we see, which is a little different than what Jeff is forecasting. Jeff says by 2031, we're going to be roughly 18% pure battery electric vehicles. What we're forecasting is roughly 25% as a result of this top-down, what is it going to take for the OEMs to comply with the legislation and be able to ship vehicles. And this forecast method, we think, shows you that there is going to be a continued acceleration of this trend and this move towards vehicle electrification. I'm going to skip over this real quick, just to, again, give you the idea. How do we see the difference between a typical forecast? I talked about this a little bit, but I think what I want to spend the next few minutes on, and again, I'm happy to share the full analysis with you. So again, you want to understand what the Biden administration means. First of all, we have a new, or proposed a new transportation secretary. He ran for president, Pete Buttigieg. And basically, he had a very strong hypothesis as far as what should happen when it comes to legislation associated with zero emission vehicles. And basically what he's done is he's targeted zero emission vehicles by 2035, which is completely in line with what we have seen in the European Union and specifically the UK. So we think this is a very viable scenario. And frankly, again, I'll just walk you through the analysis real quick. Under the Trump administration, we didn't see any mandate for electric vehicles, that basically the only driver of this was going to be consumer demand. However, when we looked at the Obama administration, basically what we saw was almost 4 million vehicles by the end of the decade had to be pure battery electric vehicles. But when we look at the legislation that was proposed by Pete Buttigieg in the election process, what we expect is he will have a strong influence on the Biden administration, and that this 5.2 million pure battery electric vehicles, or more than 50% of vehicles, would be a combination of these zero emission vehicles, which is the EVs and plug-in hybrids. We think there is going to be a significant change as a result of this administration. So as a result, this is why we believe the propulsion forecast and the move to really battery electric vehicles is significantly decreased. So I've got a couple minutes left here. I'm just going to walk you through this real quick. As I stated before, what we have is we have a $400 billion market associated with the engine ecosystem. And specifically, what I've shared is views like this. If you think about it today and you're making forging parts, there are 109 forging parts that go into the traditional Grand Cherokee. When you go to an electric vehicle, you move to less than 10 forging parts. And specifically, we've looked at this for every type of system. I shared with you what we see is going to happening with forgings and die casting parts. But here's plastic parts. And this is some analysis that we completed last year. And when you step back and you look at the amount of plastic that leaves the total vehicle ecosystem, as a result, it's roughly 30%. And what I'm sharing with you here today in this analysis, if we take the Golf, the internal combustion engine Golf, and then we take the e-Golf, the battery electric vehicle version, what you see is a significant increase in the amount of plastics that's used today. And specifically, people ask me all the time, well, where's all the plastic in this ICE ecosystem? And it's right here. It's engine covers, it's fuel tanks, it's air intake manifolds, it's reservoirs, it's hoses. It's a number of different things that are no longer needed as a result of this shift in electrification. So finally, people ask me all the time, hey, I don't see these trends happening. I don't see this impact. Point to more factors that help me understand this. And this is a slide I love to share with you that comes from Adam Jonas, who is the Morgan Stanley automotive analyst. And basically what he did about 3 years ago is he downgraded Delphi Industries, and basically what he said is, it says here is, hey, that roughly 25% of the profits come from the powertrain division, and although we don't see these parts being replaced immediately, there's a diminishing economic returns of the changing OEM priorities that creates material risk for the company. Now, what did this do? This led to a lot of changes in our industry, especially those top tier suppliers. We had the separation of Delphi into Aptiv, and then into Delphi Technologies. Delphi Technologies, of course, struggled as an independent. They've now been merged into BorgWarner. But we have seen a significant amount of activities within the supply base as a result of this. And what we have seen specifically is a number of divestitures that have come in the form of corporate carve-outs. And that's happened, as we mentioned, with Delphi. We've seen that happen with GKN. We've seen that happen with Continental. We've seen it happen with Honeywell. And as a matter of fact, the Honeywell spin out right in the fourth quarter of the year, last year, filed for bankruptcy. So we have seen significant impact as far as the shift towards a battery electric vehicle and the impact of electrification on strategies through these type of divestitures. We've seen transformative strategies. So if we take, for instance, ZF actually went out and bought TRW to help position them in the autonomous driving space. We've seen companies continue to diversify outside of powertrain. And then we've started to see, again, as Tom talked about, consolidation. Consolidation will be a solid strategy for certain suppliers as they move forward and as they start to evaluate what the best strategy is going forward. So as you think about your strategy, and I'll leave you with this note, as you think about your strategy, you'll have these 4 basic strategic options. And if you ever want to talk through what those may be, I'm happy to talk through that with any of you here who are participating today. So,
thank you so much. We do have a number of questions. We might not be able to get to all of them. Okay. If you could change the presenter over to, go ahead and change it over to Dan. While you're doing that, see if I can, if you can multitask. Do you see residual issues with the move to EV, such as battery disposal, charging station infrastructure? When will that have a long-term detriment to the EV market? I got my thoughts, but what are your? Yeah,
so I'm sorry, there was multitasking there, Tom. So can you just ask that question again?
Sorry. Do you see residual issues with the move to EV, such as battery disposal, charging stations, infrastructure, and will that have a long-term detriment to the EV market?
Yeah, what I would tell you is when you look at the legislation, for instance, in China and Europe, they're being very aggressive when it comes to the EV charging infrastructure. As a matter of fact, the Biden administration has proposed $400 billion for investment for this industry shift, whether it was for infrastructure or it was for supplier development, OEM development, et cetera. So I think we're going to start to see a significant shift from the previous administration to this administration, and I don't think it's going to be a detriment. The other thing I would add in batteries is NIO. NIO has a battery exchange program. You're starting to see a lot of this come from the new EV startups out of China, and I think you're going to start to see those strategies start to migrate.
Recycle.
Market.
Yeah.
Yep.
One last one is one thing I get hung up is in the change from EV from ICE. One major intent is to remove emissions and dependence on fossil fuels. However, does an EV rely on electricity, raw power, natural gas? Are we just moving from one?
Yeah, great question. We get this question all the time. I've got a 20-page report I'm happy to share with anybody that sort of explains this through the analysis that we've done. So again, the short answer is no, it is far better. When you take the combination of natural gas, which cleans far cleaner, and you take others, and even you take in account of coal, by far moving that value chain to the power grid versus burning it in each individual gas tank, it's far better for the environment to do this. It's a significant reduction.
Excellent. Few more questions, but we'll get to those at the end of the program. Hang with us, everybody. And I want to get Dan Bruce. moving along in his presentation of, again, we've talked about a lot of these trends, and Paul's got a great strategy outline, but how do we get there? A lot of our smaller middle market tier 1, tier 2 don't have a whole staff of strategists on board, and how can we do that cost effectively and help you look at the future and get you well positioned? So let's welcome Dan to talk about Electrification Strategies.
Great. Thank you, Tom. And thank you, everybody, for attending today. I know we're in the home stretch of the conference, but I think you're going to enjoy this presentation. As Tom said, my name is Dan Bruce, and I lead the strategy consulting and commercial due diligence service lines that are a part of UHY Consulting's transformation solutions practice. And I'm very excited to be here today to talk to you about electrification because it's such an important topic. You look at the title of this conference, the Electrification Tipping Point. We came up with that title months ago, but you take a look at some of the most recent news, and I'm going to use General Motors as an example. It couldn't be more relevant. So we've been seeing, the amount of investment is increasing. General Motors announced that, a couple months ago. But just this past week, we saw how they went even more all in. They changed their branding, even changing their logo to show how they're all in on electrification. And as I listened to their CES presentations and recent presentations, they're using very similar language. They didn't say electrification tipping point, but they're saying the inflection point, which is the same thing. So very relevant topic in the automotive industry today. I'm excited to be here to talk about it. Now, the topic of my presentation is going to be on electrification strategy. So as you've seen in these prior presentations, electrification is coming. The time to think, it's here. And the time to think about your strategy, if you're not already doing it, is now. Because having a strategy in place is going to help you navigate this change, as well as capture some of the new opportunities that come with it. So first, to take a step back, I know we have a lot of current clients listening right now, but in case you aren't familiar with UHY, I wanted to give a little bit of a background. So we're a top professional services firm. We've been serving clients for over 50 years. We have over 20 offices in the US that includes over 1,000 professionals. But we're not just a US firm. We also have a very strong global presence as a top 20 global professional services firm with over 8,500 professionals that are serving in over 100 countries. When it comes to our services, we have comprehensive service lines. So consulting, and included in that would be strategy consulting, corporate due diligence and M&A advisory, corporate finance, due diligence, which also includes commercial due diligence, tax audit, valuation, and international services. When it comes to automotive, we have a very strong automotive expertise. So we have over 300 automotive clients, and that ranges from Oems all the way down the tiered supply base. We have experts who used to work out in the automotive industry field, so they have that automotive experience. We have access to data and insights through our partnership with LMC Automotive. And we provide thought leadership to the industry through events like this, our annual Automotive Outlook Conference, as well as our quarterly publications, including our North American production forecast. And finally, we're active participants in many automotive industry groups, and I've listed some there. So now, to dive back into the presentation, let's start off, and I want to just talk about two different types of technology changes. You have sustaining, and then you have disruptive. And let's start by talking about sustaining. So a sustaining change is going to be an improvement on an existing product's performance. Typically, those occur more frequently. You usually see it as a year-over-year improvement. So for example, we're looking at that phone image. First, you have the rotary dial phone. Next, you go to the buttons that take away the rotary. Then it gets more compact. You can now hang it on your wall, and eventually the cord goes away. So those are all incremental improvements that happen over time. The company, as they make those improvements, is going to charge a little bit more, see some increase in profitability, and it's on the same product. So companies like this sustaining technologies, it's usually easy for them to work with. On the other side, we have disruptive technologies. So what's that? That's the reinvention of a product or generating new value proposition. Now, these occur less frequently. And what's interesting with them is typically when the disruptive technology comes out, their performance is a bit weaker to its sustaining technology counterpart. There may not be a market for it initially. There may not be customers. But what we see happen over time is the performance improves, a customer base is found, and it can overtake that sustaining technology. So what's important, and why I want to bring this up today, is you out there need to identify and develop strategies for these disruptive technologies before they come and overtake your sustaining technology. And it's hard because usually your sustaining technology is your higher volume products where you're making profitability. And why would you want to invest resources, time, capital into this disruptive technology that isn't going to make you money now? But it's important. You need to have a strategy in place because they come, and you want to have the strategy in place before it overtakes the sustaining technology. So this is an interesting phone example, but this is an automotive conference. So let's go ahead and jump into a transportation example. As we look at these images, take a look at the image on the left. So that is New York City. It's the Easter Day Parade, 1900. And you look at the street, and it's just lined with horse and buggies. I think there's circled one motor vehicle there. Now you fast forward 13 years, same exact street, New York City, exact same time, the Easter Day Parade. And you look and the street is now filled with motor vehicles. I think there's one horse and buggy circled there. So that's, we're talking about the 1900 time period. And that is some transformational disruptive change that occurred in just 13 years, just to get an idea of how fast it can occur. I think the other important thing to look at is not only did the mode of transportation change, but what else around that occurred? What else changed? So you take a look at that table on the right. The fuel source. So you used to be feeding your horses. You had water and food troughs. Now you're powering vehicles with gasoline. What about the surrounding infrastructure? So the road on the image on the left was dirt. Now at the image on the right, you've moved to pavement. What about the materials in the vehicle? Well, your horse and buggy was primarily all wood. And now you take a look at the motor vehicle 13 years later, and I see metal, I see rubber on the tires, I see glass. And what about even into some of the components that share some similar components? So your lighting. Used to use candles to light with the horse and buggy, and now you're into electric headlights. So I bring this up to show, there's a lot of parallels when we look at this transformational change to the electrification change that we're talking about today, not just with, going from an internal combustion engine to a battery, but the surrounding infrastructure, for example, going from gasoline to a charging station and components that are changing. So that's a historical example. Let's jump into the today. And we've talked about, back to electrification tipping point. So we've been hearing about electrification, but why is it so important now, if you haven't already been taking it serious, to take it more serious when it comes to strategy? And I like to use this, this graph I have up on the page. So there's a rapid acceleration of adoption that's expected over the next 10 years in electrification. And this graph's going to help explain that. So if we take a look at it, what this is the technology adoption S-curve. So the y-axis, you have market share of a particular technology. So how much of that technology is sold in the market? What share of the market is it? On the x-axis, you have, these are customer segments, people that would be buying that technology. And it starts off flat, quickly ramps up, and then gets flat again. And it starts flat because you have your initial customers, which are your innovators, typically risk takers, willing to try new things, not very price sensitive. You then move into your early adopters who have some similar characteristics, but going to be a bit more price sensitive, but want to try the new things before you move into your majority. So now that's where the masses are buying into this technology. And finally, there's the laggards who are just slow to get on board. So if we look at where we are now, especially with BEVs, and you look at the market share, we have just started to enter, and looking at 2020 at the market share, the early adopters phase. So still creeping up the flat part of that curve. But if you look at some of the projections that we saw from Paul, on where we're going to be by 2030 and the percentage of market share, maybe at 25%. Well, now you're entering into that early majority. And it's very important that as a company, is you're going to be more likely to be successful in your electrification strategy if you plan, develop, and execute your strategy before that adoption S-curve starts to hit that early majority. And I hear when I talk to a lot of, especially as you go down the supply base, the tiered supply base, well, it doesn't impact me. I don't make engine parts, and it's not impacting me. Well, electrification is going to impact every vehicle subsystem. So let's look at some of the examples. Powertrain, drivetrain's easy. You know, your internal combustion engine and your transmission are transferring over to a battery and electric motors. What about the chassis and frame if you're making parts for that? Where you're going from, and even though we've seen these platforms kind of get consolidated over time, they're still unique, they're still complex chassis that are now going to be replaced with a standardized skateboard. So now you're gonna have one skateboard that's for all the vehicles, and you're gonna place a different top hat on that skateboard, depending on the top hat of the vehicle. Electronics, you now have some very high power electronics that are being introduced into the vehicle, and getting converters, inverters, onboard chargers, so all new components that come into play. The climate control, so if you no longer have an engine, you can't use the engine waste heat to heat your vehicle. So there's going to be more heaters that need to come into the vehicle to take on that. On the exterior and exterior side, you're still going to see this lightweighting trend continue. So that came into play as part of, and we were talking about it before, the fuel economy standards trying to lighten the vehicle. But you know, as you look at these batteries, they're very heavy, and you're going to need to reduce vehicle weight in order for the battery to get more range, which is important. So you're still going to see these new materials introduced of advanced high strength steels, aluminum, plastics, and carbon fiber. Finally, the suspension and braking, you're going to see more regenerative suspension and braking. That's going to help extend the battery range. So let's dive quickly into just kind of a deeper example as we go down the tiered supply base. So looking at powertrain, you know, you have some major component differences. So Paul touched on this a little bit, but your full battery electric vehicles, BEVs, they're going to completely eliminate the ICE powertrain components. So your engine, transmission, fuel tank, exhaust, alternator, starter are all replaced by these new components: battery packs, electric motors, DC-DC converters, onboard chargers, inverters. These are still around. You're still going to have a mixture of both while you're in the hybrid, the PHEVs and the HEVs phase, but it's a completely different component change that needs to be taken into account as you go to the BEVs. And let's take a step now even further in the tiered supply base. And let's take a look at, okay, I'm a metal stamper, or I'm a metal caster, or I'm in plastics manufacturing. What are some of the impacts and opportunities that I'm going to see? Well, starting with metal stamping. So there's still going to be some stamping involved. You're just going to be stamping a different part. So if you're stamping for a part for a transmission today, you know, there may be stamping, but it could be for an electric motor. And what are some things to take into account, or the new opportunities there? Well, the materials that those components are made out of. So as we said, the high strength steels, the high strength aluminum, some of those lightweighting components. There's also a whole new electrical steel. So electric vehicles, especially in the motors, are using these electrical steels, non-grain oriented. And you also have charging stations that are going to need electrical steels. And you're going to need a lot of charging stations. And so with those two types of materials, that's not something you can just convert to overnight. There are different capabilities that are required. There are different processes. And so you need to think about that as you look at the different components. What about on the metal casting side? So you're no longer going to have these large cast blocks for your engines and transmissions. So what do you have to think about if you're in that space and looking at new opportunities? Well, one, are there some non-powertrain automotive components that I should shift to? Or two, maybe I need to now look at using that capacity in non-automotive markets. Finally, as we look at the plastics, so lightweighting is going to continue. You're going to continue to see this metal to plastic conversion. And you're going to have things like sensors and the high power electronics that are going to have some plastic opportunities, as well as certain areas with enclosures, and around the battery and cooling compartments. So kind of pulling all this together, I think with the first few presentations, and now with this, hopefully it's been emphasized, the magnitude of this change and how quickly it's coming. I mean, we've talked about the OEM investments. You know, we've seen some of the volumes, legislation, and how that plays a role, as well as the technology improvements and cost improvements. And we're at this tipping point. And so the emphasis is, if you have not started a strategic planning and analysis or a strategy on electrification yet, the time to do it is absolutely now, because we are at that tipping point. And the strategy consulting team here at UHY, we have experience helping clients with their electrification strategy. And so what I want to do over the next few slides is lay out a framework that we use, and also to help you understand, you know, what are some of the key phases in your strategy development process and what to look for and do at each phase. And so this image shows the 3 phases to the strategy framework. So first, you're going to do planning and analysis. That's where you're gathering data and information to help determine what's the best strategy to take. Second phase is development of the strategy. So you evaluate based on that data and information, here's the strategy to take, and you develop it out. And finally is the execution of the strategy, and maybe the most important part. And here at UHY, we have the services and expertise to be able to help end-to-end on the strategy development, as well as jump in and help with any portion. So let's start first with the strategic planning and analysis and dig into it a little bit deeper to see the activities that are needed. So again, this is gathering and analyzing the data that you need to determine your best approach. And what are some of the key activities? Well, a strategic planning workshop might be a good way to get started. This is where you're going to create strategic initiatives that are aligned with your company vision. So maybe get together with your executive team, with your business unit team, and talk about strategy and what's needed. Capability assessments. So taking a step back, looking at the capabilities your company currently has, looking at what's needed. So if we're going to go into this electric motor component, what capabilities do we need? And then comparing your capabilities to what's needed to see where the gaps are and later figure out how to fill it. Product portfolio analysis. So that's really determining, are you focusing the right resources, capital, and time to the products that you should be focusing on? Market and product analysis. So here in this particular case for an electrification strategy, you're probably going to be looking more at the product. And you want to see, hey, this new part that I want to make for the electric vehicles, is it, what vehicles is it on? What do the volumes of those look like? What is it growing at? Is there one component or multiple components? What's the fitment on the vehicle? To get an idea of timing, size, and growth for that product. Customer and competitor analysis. So that's where you're looking at your customers and competitors. On the customer side, looking at, hey, what are their needs? What are their requirements? And on the competitor side, hey, what capabilities are our competitors coming out with? What's their product pipeline? What are their key customers? So once you gather all that data together, it can lead you to the evaluation of your strategy and the next phase, so which is strategy development. So here, utilizing that data to come up with the best strategic approach. And obviously the approach is going to depend on your company and the data that you analyze. We listed a sample of strategies here, as well as some electrification examples, so real world automotive examples. And these are kind of your OEM tier 1 suppliers, but these strategies can be applied, or some variation of the strategy can be applied all the way through the tiered supply base. And we'll look at the advantages of the particular strategy. So first, a joint venture or partnership. The example here is Ford and Volkswagen. So they formed an alliance to share the MEB EV platform that VW has. Why would you do this? What's the advantage? Well, you're sharing resources. Now you both don't have to be investing in R&D and product development. You're scaling up and improving your market position. So obviously those are two very large companies. They're able to scale up together and become even larger. Another sample strategy is an acquisition. So the example here is when Dana acquired TM4. So they did this because they wanted for their powertrain to get in-house electric motor, power inverter, and control system capabilities. And so what's the advantage of doing the acquisition? Well, you quickly, and the emphasis there is on quickly, gain the capabilities as well as control. That's one difference between the acquisition and the JV. You get control in the acquisition over that technology and IP. A divestiture. So the example there is American Axle, and when they sold their casting operations. Why would you do that? Well, it can help you focus, and streamline your resources and reprioritize. In their case, they did it to reduce debt, enhance the margin profile, and streamline their business. A market entry or expansion. So the example here is Big River Steel. So they already make steels, but they expanded even further into the electrical steels with a $1.2 billion expansion to their plant to make those non-grain oriented electrical steels. And so this is where you can use your current capabilities to diversify your offerings and increase growth. And the final sample there is product and service commercialization. So Plugless is in there. So there is a new entrant. They came up with a wireless EV charger. It was the first to market for inductive EV charging. And here, if you're looking at that, this is differentiating yourself in the market and finding a way to increase your growth. So the third phase and the final phase here is strategy execution and implementation. And this may be the most critical phase of the whole process, because if your plan is really good and your development is really good, but you don't execute it, the strategy isn't going to be successful. So the key activities are going to depend on what your strategy was. If it's transaction-based, you're going to have discussions, negotiations, due diligence maybe, financial, commercial, and operational, as well as some post-merger or post-acquisition integration. If you do a new market entry, maybe you're going to have to do some capital investment for machinery, equipment, technology. In really any case, you're going to need to recruit and hire some new skill sets. But one area we like to emphasize as you're in this execution and implementation phase is having a project manager or project management to oversee it. That's really going to help provide you a roadmap as well as drive the success of the strategy. So what are they going to do? They're going to develop an implementation plan with assigned responsibilities, goals, objectives, timelines, and really hold some accountability to that to make sure it's getting done. May also develop some key performance indicators, and that way you can track, monitor, and report progress on your strategy. And so that concludes the presentation. I want to just finish by saying again, how critical right now is, we're at this electrification tipping point. And if you do not have a strategy in place, or you have a strategy in place that's in development or not fully executed, now is the time to take it serious, because we saw how quickly disruptive change can come and overtake some of these sustaining technologies. And we at UHY, our experienced strategy consulting team, we're ready to help advise your strategy. So please contact me if you have any questions on the presentation today or any of the presentations you saw today and want to talk strategy or electrification. I'd be happy to talk. Thank you again, and I'm going to go ahead and turn it back over to Tom.
Great. If you could just change me over to presenter too, for Dan. Again, thank you so much. I mean, this strategy piece, we can't emphasize enough that this looming change is real. It's something that we believe is going to be very, very critical. For every supplier to get on board with. So again, contact information for all the team members. We do have just a couple minutes. I have a couple questions that were lingering out here. Can you provide some visibility on the percentage mix of labor content versus automation for EVs or ICE? I know I have some thoughts on that, but that's Paul or Jeff. Anybody want to chime in on that one?
Yeah, I don't have anything specific. So if you guys want to take it, go for it.
Yeah. Actually, what I would say is we don't have specific data, but if you look at the type of components that go into this, and this is what I tell people all the time, electronic parts scale differently. And if you think of the manufacturing that goes into an engine versus the scalability of electronics, it's an apples and oranges comparison. I think one of the interesting statistics we heard from the GM Battery Investor Day was this, is that GM has 550 engine and transmission configurations globally. When they go to an all EV future, they will have 19 skateboard variations. Now just think of the complexity reduction that means from a manpower standpoint. We can all visualize what that looks like, but instead of making and machining parts that are very, very labor intensive, they're requiring, they're relying on semiconductors and wires and just a very, very different foundation for all of this. So I think that's the best way to sort of start to help to articulate how big of an impact this may be.
Yeah, I think the impact, I think there's quite a bit less labor content. And you can see, I mean, the amount of vehicles that are being pushed out of, even the Tesla plant in Austin is projected to do almost 1 million vehicles. I mean, I don't know what's the closest one, 300,000, 500,000. I mean, so this is going to be, there's just less components, there's less people, there's less parts put together. So it's definitely going to have an impact. In addition to the chip shortage, there appears to be restrictions in the supply of steel as well. Combining this with President-elect's plan for increased infrastructure spending, do you foresee any impact on steel supply? Certainly, probably there's going to be pressure on pricing for sure. But
yeah, I would agree with that, Tom. I think that's something that obviously has ebbed and flowed with tariffs and other issues over the last 18 months or longer. And I think pricing pressure probably returns to that. Spending obviously is going to increase demand.
Yeah, and final question, yes, we will be sending out in an email the presentations for you, so you would have all those to review. So again, we want to thank everybody that joined today. I know it's been a couple hours, but I hope it was very informative. We've been trying to really stay on top of this, and even the last 5 years, really focusing our efforts around our middle market supply base. So reach out to us. We're happy to help and get you focused in the right direction, and maybe you are. And because there's certainly areas that we're going to see tremendous growth, and we're going to see certainly some areas in our supply chain that are going to be under significant pressure. So let's make sure on the right side of that. And again, I want to thank Jeff, Paul, Dan. Can't thank you enough for joining us. Excellent presentations, and really look forward to getting together again and doing something in the future. So thank you, and we'll sign off if that's all we have. So,
Great. Yeah, thanks, guys.
Thank you.